Good afternoon. This is Tom Alexander. It is Saturday, June 4th in beautiful Charleston, South Carolina. And this is the weekend report. This is the video portion of the written report that reviews the written report, gives a little more detail. Do me a favor, if you have not subscribed, please subscribe to my channel. If you like the video, please like it. You can hit the notification bell if you'd like to be notified when I post something. And by all means, if you have questions or comments, post them below. I will respond to any question or comment that is appropriate. Okay, let's start by looking at the weekly indices. And we will share that screen. Let's see. Let me find that screen. Okay, what you see on my screen are the weekly charts of the four primary U.S. trading indices. These are the cash charts. The levels on each chart are the important intermediate term levels. You can see we closed on Friday, maybe a little bit above halfway between those two levels. Now, if we go down in time frame, which we will do, you can see we have, well, that's the futures. I want to go to the cash charts. Here we go. Here are the cash charts. Okay, here are the cash charts. Now, if you look at this, it's very clear, and this is in the written report, that we are in balance areas that basically took all last week to form. And what follows balance is imbalance, a trend, and typically that trend is quite strong. Now, the indices are a little bit in different positions from a structural perspective. Specifically, the S&P and the NQ are near their balance area low extremes, whereas the Russell is near its upper extreme, and the Dow is holding up much better on a relative basis than either the S&P or the NDX. So it's not like things are in lockstep here. If there is a breakout, for instance, and I put this in the report, if the S&P and the Dow, or the S&P and the NDX, which are near the two that are near the lower extreme, if they were to break to the downside and take out the balance area lows that you see highlighted on my screen here, that is a signal that there's an initiative trade beginning to the downside that could be substantial. Now, when we're trading the stock index futures, when there's a move that contains conviction and it's quote unquote a real move, all four of the indices will move in lockstep. So what you would also want to check then is to see if the Russell is beginning to show and is showing weakness, even if it doesn't immediately break to the downside. If there's going to be something substantial to the downside, all four of the indices will take out their respective balance area lows. If they don't do that, then it could be signaling a false breakout trade the other direction. Now, the same thing applies to the upside. If we see relative strength on Monday in the cash session with the Russell breaking to new highs and maybe the Dow breaking the new highs, and then the NDX and the SPX can't follow through, then that's a heads up as well. The really, really, really important levels on an intermediate term basis are on the weekly charts. And those levels, basically the upper levels on the cash charts are the same as the weekly charts. And then the critical intermediate term levels are the recent lows. That recent low down here that occurred on the 20th in 3 of the 4 is a very, very important low. And it could be an intermediate term low leading to substantial further rally, yet to be determined. Okay, let's take a look at the profile view. Now, this is a weekly profile view. I post a profile chart, at least one profile chart every week in the report. outlining the potential path the market could take. And the market certainly has a path up to this 4,300 level, but it also has a potential path back down to test these lows. And that is outlined, is highlighted in the report if you want to take a look at those two paths. Okay, if we look at the internal situation of the market, I'm going to start with breadth and we'll come back to this chart. We had an incredible expansion in breadth that began following this buying tail. It took a couple of days, and then the market really began to launch on 5/24 and was straight up for 4 or 5 straight days. And, you know, as usual, you're not going to continue the rate of change that we saw in this first 4 or 5 days, but you generated a tremendous amount of upside momentum. Now, the 10-day moving average, certainly the 5-day moving average, reached an extreme we hadn't seen since after the March 2020 low, shortly after that. But it's this type of momentum is something you typically see on a kickoff move. So yeah, it is a little bit a concern that the 10-day moving average is as close to an extreme as it is, but the market can go considerably higher before this has any effect on the market. So we'll see what happens early on in the week with the break of this balance area. I do think we'll see a break of this balance area early in the week, and then we'll see how the markets, the various indices, the 4 indices, each of them respond. If they're all moving in lockstep, if they're all moving in lockstep up or down, then that's the direction we want to head. If we have this disparate activity with, say, the S&P breaking down, but the Russell and the Dow not, then that's a heads up that could be a false breakout. So there are questions about which way this market is going to move very short term. On an intermediate term basis, I'm working under the assumption that we have an important low in place. And even if all 4 of the indices take out their respective balance area lows, that we find some sort of level that holds down here, and then there's another attempt at rally. Now, that's all subject to change. Every single day offers a new piece of information. It's a new piece of price action on a daily basis, and that has to be weighed in light of what you think has happened. And if it requires a change, then you change your working assumption, and that's certainly what we will be doing in here. Okay, let's take a look. Oh, I know what I want to show. I want to show another piece that I don't typically show in the report. That's not it. And it's here we go. All right, this is a chart that I keep up on one of my screens during the day. And it's simply, this is the S&P futures contract, but it's the cash session. And then below it, we have breadth, NYSE breadth. And what you saw on Friday we had the gap down, and then we had just a narrow range chop fest of a day, very little price damage. And breadth during Friday actually reached down very close to negative 2,000 at one point, and it went out negative 1,400. Well, the fact that we declined as little as we did and breadth contracted as little as it did is potentially bullish. It's potentially a bull trend signature. You've heard me talk about the relationship between price and breadth, and that relationship being different in a bull trend versus the bear trend. And in a bull trend, this is what you'll see. You'll see a market that retraces in terms of price, but that the damage price-wise is very little, but you get this relative outsize contraction in breadth. And that's what we saw on Friday. So this is potentially bullish. We'll see. Obviously, price dictates. If we do break to the downside out of these balance areas and breadth craters, well, then that's wrong. But this is something that we want to be watching. I'll be watching very closely on Monday. And it's potentially bullish. Okay. There was another, I know. Okay, we've been talking about and following 10-day average true range and VIX, the volatility index. And both had been extremely elevated and had stayed elevated for quite some time. The short of this is that it's bullish for the market to see average true range contracting and VIX contracting. And if we're going higher, those will continue to come in. So guys, I hope you found this useful. Enjoy the rest of your weekend, and I will speak with you again soon.